Hello, this is Ashraf Laidi, and welcome to this new edition of special video market analysis. In this episode, I'm going to focus on what is probably the most important pair in the currency market, which is the euro dollar, and also the US dollar index. 57. It's the US dollar index is a basket of currencies of 6 currencies, and 57% of which is occupied by euro dollar. So basically, you will see a sufficiently convincing inverse relation between the euro dollar pair, this one here, and the dollar index. And the big story here is that after we had a nice rise in the euro dollar in the first 8 or 9 months, we had a sort of a decline, and part of the reason, and it was sort of accelerated by the ECB's decision to, even though they wanted to curtail or to taper the QE, they extended the period of time, and they communicated in a way where they said they are not in a hurry to really tighten policy rates. So, but let's just focus on the price here, which is very important. Now, for those of you who like the fundamentals and want to pay attention to the fundamentals, one of the main catalysts to this gain here, today's gain, is the higher than expected GDP figures from Germany that came out. We expected to come in at 2%, and it came in at 2.3% from 1%. But that's not really the key here. What we want to talk about, is the price, and we are reaching very important levels. Whether you're bullish or bearish euro dollar, whether you want to play the rebound, whether you want to anticipate what is expected to be a fake rebound, whether we are going to look at all of this. So let's just start with the euro dollar exchange rate here. So basically, whether you're a fundamentally oriented trader or you're a swing trader, or there's a very important pattern which usually works, and it's, I would say, usually, but the key here, it could be an exception, and this is sort of a head and shoulder, which is, we're seeing a head and shoulder here, which is basically bearish. It is a bearish formation, and we've got we've got the shoulder here, the left shoulder, we've got the head, and we've got the right shoulder, and this is the neckline. And basically, what it says is that as we have this formation, if this formation is going to be valid, meaning if it's going to materialize, that means that its intended target will be, so the distance from the head to the neckline, so from 121 to let's say 117, so 400 pips, so 400, okay, minus 117, so we will be looking around 113. So this is the theoretical target, this is the target, or the implied target of this head and shoulder formation, if, and I underline, and I bolden, and I exclamate, if this pair does materialize. And if it does materialize, then we would see 113, which coincides with this very important level, which is the 200-day moving average. For those of you who have been trading the euro dollar, the 200-day moving average had served as a very, very important resistance until the first round of the French elections, when Macron won, and that actually broke. So, the 200-day moving average. I'm sorry, on the daily chart. On the daily chart, this was the key level here. So it was just around May, and the breakout. Let's just try one more time. So the 200-day moving average served as a big resistance, and it failed multiple times. And this is the first spectacular failure, which is basically when euro dollar rose for around 40 minutes after the announcement that Trump has won, November of last year. And then we had a failure of 200-day moving average, and we had another attempt, and we failed. And then finally, we broke on that Sunday, famous Sunday, the 24th of the 23rd of April, the first round of the French elections. We finally broke. We closed above the 200-day. We meandered just above it, and then it was a combination of a gap, an upward gap, a gap up price, and a break. Okay, so as this moving averages rises, it gets to 113, and 113 is the theoretical, and I would say the theoretical target of this head and shoulder formation should it work. Now, what's important here? Instead of playing the game, is the target going to materialize or not? Is the target going to materialize or not? We don't have to, as a trader, you don't have to stick to this game only, but what is the important thing is play by the other cardinal rules of the head and shoulder, which is basically the neckline. So if we do close a day, and more encouragingly the week, above the neckline, so just above this level here, just around 117. If we do break above 117, that is a good first condition in this very head and shoulder. And I would say first condition, meaning a very first condition in canceling or invalidating this head and shoulder. But you have these important levels, they're confluence levels, and so they're basically they are levels of various schools of technical analysis that point to similar levels. So we are seeing the 100-day moving average, which coincide with this neckline. And basically, and the neckline here, even though, yes, there's a shadow here, there's a lower level, you got to focus on the closing level. So 117 is a very important level. It's not really the lows, but it's really the close here that matters, okay? And so essentially what you can say that this level here, around 117.18, 117 is really a key support, and now turning into resistance, okay? And in order for us to remove or to break or to invalidate this negative or bearish formation called the head and shoulder formation, we would like to see a close daily, meaning a close above 10 p.m. London time or 5 p.m. New York time, okay? Close above, and preferably the week, above 117.30, okay? So it will be a confluence, a break of the trend line resistance, number one. Number two, the 100-day moving average, and number three is this visual sort of base here, which is neckline, in order for the euro dollar to negate this bearish formation, okay? And then and you have to be careful how I'm going to complete a sentence. How to continue higher? Well, here is the third or the fourth condition, which is the shoulder, okay? So if we do say that this is the shoulder, it's around 118.70, so this is a left shoulder, and shoulders do not have to be exactly identical at the same level. Actually, a lower shoulder for a regular lower shoulder alignment would be actually quite valid for a regular head and shoulder, as a higher shoulder alignment in an inverse head and shoulder, which is a bullish formation. But so what we're looking at is that the 55-day moving average, which is around 118, is probably going to be the next moving average requirement for a potential break above the shoulder. So if we do close above the right shoulder and we stay above it, then that would be a more definite denial or negation of this head and shoulder formation. And closing above the neckline would also be one of the first elements or requirements of it, but it would be one of the first prerequisites to start to shed doubts on this. Now, what is interesting here, what we're seeing is that the markets have been in a range, and the next big meeting is really the ECB. Actually, this year, the last ECB meeting of the year in December is actually going to be after the Federal Reserve decision, which is expected to raise rates, and not before. So this is going to be interesting. Some people say, well, the ECB meeting in December may not be that important because the more important one will happen already. But we can, I know, as I will talk in the next episodes or in the next few episodes in the next few weeks, Draghi and the ECB could always change and play with their economic forecasts and tilt the expectations. But So this is what's important. And why is this important? Because if we look at the sort of mirror image of the dollar index, which is also a tradable index or asset, what we're seeing the beginning of a potential break of this trend line. Okay, this is a daily chart, and this is quite important. So a lot of dollar bulls were jumping at this, and were very excited when they saw this, because they looked at this inverted head and shoulder in the dollar index, left shoulder, head, right shoulder, distance between the head 91 and 94, okay, is the intended target of around 96.8 or 97, which is around the 200-day moving average. Okay, so a lot of people were saying, yes, we're going to see 95, we're going to see 96, but it's taken a while, and I would love to speak about the fundamental reasons of why there has not been a follow-up here, but we can do that in the next episode, or I can do that in the next article that I'm going to be writing here for GKFX. But one of the things is that, yes, even though the market is expected more than 70% or 80% chance that there's going to be a rate hike in December by the FOMC, there's not expected to be much of a follow-up. And if you're trading here, basically you need to know that we're going to see the CPI numbers from the from the US, sorry. So today we're the 14th, and then you're going to look at the 15th, basically the US CPI at 8:30 New York time, or 1:30 p.m. London time. Okay, and we're expected to see slightly better than we're likely to see sort of a rebound. This is what we need to focus, is the year-on-year headline expected to slip from 2.2 to 2%, and the year-on-year core expected to remain unchanged, 1.7. We know that the Federal Reserve looks at the core PCE price index, which is another inflation target, which is very similar to it, and it's a 1.4, not 1.7, so it's slightly lower, but it's either or. They're still below the 2% requirement. So again, the bottom line, ladies and gentlemen, is that this Tuesday or this week, we need to see whether the dollar index closes below 94 or not. More importantly, for a euro dollar, focus on this 117.20. So if we end the evening, people are going to be busy, this evening, or tomorrow with their requirements, around 10 p.m. London time. You need to see whether the market, or whether in your closing value in your daily chart, okay, the end of 14th of November, whether your candle chart ended above or below, let's say 117, 117.40, 117.35, just to see that there is, just for us to be on the safe side, whether that qualifies, or the beginning of what could be a break of this downward trend. Okay, so, and if we do close, let's say below 117.35, 117.40, then you can say that the market still want to have another go at probably towards 117, 116.80, 116.20. Okay, and that's what you call really a range bound market until we get more of a clarity. So this is quite important. The importance of the GDP numbers from Germany just shows that things are going back to normal, and not only in Germany, but also in sort of the so-called Club Med nations, which is just another reason for the market to believe that, listen, there has to be less and less reason for the ECB to continue to extend the duration of its QE, even though it's at a smaller size, okay? There may be a chance that they will not end it in September of next year. They may end it before the end of September. So this is what's important. And just one last thing, if you look at dollar yen, you will see that there is a very important range trade. For those of you who like to basically, buy low, sell high, or, trade, trade within a range. Basically, very important support to 113, very important resistance just around 114 or 114.30. So there is plenty of chances here to see what's going on. Very interestingly, today we saw dollar yen pushing higher and euro dollar pushing higher. Okay, so basically the dollar was doing different things, again, different pairs. So plenty of information. So you can do the range bound trading, you can do all of that, but keep your eye on the bull. And what is the bull? Is 117.40, 117.30. Very important level, very important confluence levels in the euro dollar. Very important pair because it occupies around 24 to 23% of the spot foreign exchange market as far as spot FX market in this market. So euro dollar occupies around a quarter of this, and that's why this is a big deal, and it's a very important trending pair. Ladies and gentlemen, thank you very much, and all the best.